Let's go through the value creation paths, and there are 4 different value creation paths. And to understand the value creation paths is really important because every play in the private equity playbook will be based in one of those. The first value path, the first way that you can create value for a company, additional value for a company, is what we call vertical sliding. Vertical sliding, and you are already familiar with this chart, the value chart. Vertical sliding is sliding down the net tangible assets. When I sell an asset, and this asset will not impact the free cash flow of the company. When I sell the asset and lease it back, or when I refinance some asset to improve the leverage of this asset, I'm reducing the net tangible asset. And when I do it, automatically I improve the operational premium. And if I improve the operational premium, I'm improving multiplier. And if I improve multiplier, I create value. This operation will not actually change the company value, but it will create additional capital. When I sell assets, when I refinance the company, I'm creating additional value. I'm creating additional capital. This is a play that usually it's called, I prefer to call rebalance play. Balance because we are working here mostly with the balance sheet of the company. So we are readjusting the balance sheet of the company. This value play a lot of times has the name as reset play, or the names that I don't like, strip and go, dismantle and go. I don't like those kind of words. It's just that we are trying to rebalance the balance sheet. And I can give you some examples of companies that have been through 4 rebalance plays in a row. So a private equity goes buy a company that is worth 100 million. We find ways to sell 10 million in assets that will influence little on this free cash flow value. We take 10 million out of this company, we resell the company for $97 million, and we have created $7 million out of this. So this is not creating any kind of business improvement. It's just improving multiplier, and with that, we create value for our investors. I personally think this is always part of the value play, but I prefer to not to buy a company just to do a rebalance play. I think this is kind of lazy. So let's go to the second way. The second way is portfolio managing. You remember that we never look at a company just as a company. We subdivide in cash flow units. When we do it, we have cash flows units in every place on this chart. And this chart is actually subdivided in the middle. You have the right side of this chart and you have the left side of this chart. When a cash flow unit is on the right side of this chart, it means that this cash flow unit creates a positive operational premium. And usually we are going to call this cash flow unit a champion. If we find a champion inside the company, this is gold, okay? Because this is something that we can replicate. Let's imagine Boost Juice. So I know that I can invest $500,000 to create a new Boost unit, and this Boost unit will create cash flow, and this cash flow is actually worth 1 million. So I automatically create value with growth because I have something to replicate. On the left side of this chart, we have the cash flow units below the net tangible assets value. This actually means that this cash flow unit has a negative operational premium. In direct English, this cash flow unit is destroying value. If you have a sinkhole inside your company, for private equity is actually good because we also know how to create value with sinkholes. And the easiest way to create value with sinkhole is actually to divest this part of the company. This is kind of I think a misunderstanding of most of executive teams. When they look at a company, they look at the underperforming part of the company, and they put a lot of resource trying to save this underperforming part of the company. Private equity, when look at a company, we look at the underperforming part of the company, and our perspective, how can I throw this out of the window? Okay, how can I reduce the things that this company doesn't excel at? And I will focus all my attention on what this company really excels, what this company is the best in class, because there is the real value. The good thing here is that if we have champions, we know how to create value. If we have sinkholes, we know how to create value. Usually, the strategy that is just to liquidate sinkholes, we are going to call liquidation play, and we are going to talk further about this play in a minute. And if you have a champion, then you go through the most important growth strategy, that is the replicate play. The third way to create value out of four, it's almost there, is the horizontal sliding. Different than the vertical sliding, I'm trying to improve the multiplier, is sliding the company to the right. So actually, I'm creating a future company, a future cash flow unit that has a value potential. This is the most classic way to create value used by normal executive teams. They look at a cash flow unit and they think, how can I create more profit out of this cash flow? How can I make this more efficient? How can I make the company better? So this is the most normal, the most classic way that executive teams create value. And because it is the most classic ways that executive teams will create value, we are trying to avoid those paths. This is the path that private equity will try to avoid. We will try to avoid, not because it's not powerful, this is really powerful how to create value with the horizontal slide, but because every executive team knows this tool, they have already overused. So the space of additional value in improving a cash flow unit will be really limited. We will try actually to look at everything else that the executive team hasn't been looking at. And as I said before, when you look at the free cash flow, the free cash flow value, most executive teams will focus on the free cash flow. They want to make the company more profitable, and they will not have enough attention on company risk, growth rate, what is the strategic position of this company in the market. Those are dimensions, those are factors that the private equity will focus their attention. So when we think about horizontal sliding, we will be thinking much more about company risk, what is the growth rate of this cash flow unit, what is the strategic position of this cash flow unit in the market. Those are the things that the private equity will focus on. Because the horizontal sliding is overused by your executive team, usually to have a value play here, it will need to be a really specific value play. So all those, we have several plays here in the horizontal sliding. We call them sliders. They're sliders just because, we are not creative here. They just slide in the company to horizontally. When we buy a company, focus on a slider, it will need to have one specific thing that we are looking and say, okay, there is this, and because there is this, we definitely have some value in sliding the company. Often company play is a play that we are going to talk further in a second, but we have several things here: prima donna, lonely wolf, widow company. All those names, yeah, here we are kind of creative. They are pointing to something. Prima donna play is when you have usually the CEO that is let's call a peacock that thinks that they know everything, and it's impossible that someone knows everything that you need to create value, because value is a really wide topic. So when we look at a company and we find a prima donna, a CEO that doesn't want anyone sharing the spotlights with they, we know that there are mistakes, there are uh, wrongdoings inside this company, because you don't have enough knowledge inside this company. The same happens with the lone wolf. Lone wolf is quite common in the tech market. Usually is the founder that is really good in creating a product, but they know that they don't know how to do the commercial part, how to do the finance, how to do the capital raising, all the different dimensions that the company needs to be a successful company, they don't have. So just giving some examples here, that when a private equity looks at the company and we find a slide that play needs to be something really specific. We never buy a company with a fantastic executive team and say, I can do this better than you. We don't do it. The fourth way, merger and acquisition. Merger and acquisition is something that private equity use a lot, and I think much more than the normal company. But there is one specific thing that needs to be inside the merger and acquisition to create value through merger and acquisition. That is the knowledge gap. And this is not simple to have. A lot of people think about merger and acquisition and they believe, a lot of executive teams, a lot of CEOs, chairperson, I think they want just to be on the front page of the Australian Financial Review, and they make an acquisition, a merge. This will create value just if you have this knowledge gap. If I know how to make the best pizza in town or the most profitable pizza in town, makes sense to acquire all the pizza place. Makes sense to acquire all the assets that are inefficient. And because I have a different knowledge, a better knowledge, I can create value with those other assets. This is what needs to be behind the merger and acquisition to create value. If you don't have that, you will not create value. And I think this is why a lot of the merger and acquisition actually fail, because since the beginning, they didn't have this knowledge gap behind them. There are two main value plays out of merger and acquisition: the consolidation play and the spearhead play. The basic difference between them is that in the consolidation play, you are buying similar assets, and in spearhead play, you are buying complementary assets. They will have different approaches on how to do the merger and acquisition, but basically this would be the difference.